Hello there, and welcome to this latest session on strategy, marketing, and brand. In this particular session, we're going to talk about pricing, knowing when to raise them, hold them, and fold them. My name is Frank Spivak, and for more than 30 years, I've helped organizations enhance their image, engage their customers, and enrich their businesses. I've been president, chief marketing officer, part of the management team. I'm a writer, author, speaker, trainer, coach, consultant, a lifelong learner. I think something that I would encourage everyone to be. And I'm also a motorcycle rider and trainer. I do help people with doing precision motorcycle riding. So for this session on pricing, we all know, we see the headlines, we see that inflation is going up, the Fed is increasing interest rates, we see issues with supply chain, we see demand issues, we see influences from the war in Ukraine. There are a lot of things that go into pricing, but it's also important to understand where you are, what you need to do with your pricing in order for you to make a profit and keep your company going. In essence, profit is your oxygen. If you don't have profit, then you're going to die of suffocation. You will not have an organization over time. So as we get into this session on pricing, I want to cover a few basics that I think everybody should understand. The first is that bookkeeping is the process of actually recording all the transactions of the business. This is just making sure that everything that's been paid or received or anything of that nature is recorded somewhere. Accounting is the process of actually categorizing all those transactions so that it makes sense in a business reporting process. Finance, on the other hand, is looking ahead and saying, okay, I have this money. What am I going to use it for to help the business grow? So understanding that bookkeeping and accounting are actually past tense activities, and that finance is a future tense activity. One of the most common reports that you would be getting from your accountant or your bookkeeper or whoever you have doing your books is your income and expense report. This shows all of the categories in which you have raised money, all your revenue, sales, contract, service subscriptions, anything that's taking place that is bringing in the money. It also shows the cost to produce those revenues, which is commonly referred to as cost of goods sold. The remainder of those sales minus the cost, and that translates into gross profit, and shows the expenses of running the business. And when you take all of the expenses of running the business after your gross profit, the remainder left over after the paying the bills, that is your net profit. Your balance sheet shows all of the assets of the business. How much do you have in your checking, savings, investments? In inventory, accounts receivable is an asset because people owe you money. The balance sheet also shows you where all of the bills of the business are: the mortgage, loans, accounts payable, and the owner's capital in the business. There are some other reports, such as the cash flow or use of funds report. And this shows how the cash of the business was raised and then where it went. How did you spend it? How did it come in and how did you spend it? And it reports on whether you actually increased the amount of cash in your business or decreased it. Now, this is entirely different than your income and expense report, because as we see from a lot of technology companies, that you can lose money from a profit standpoint and still increase your cash flow, and vice versa. So you can actually bring in money, have a profit, but it is at a cost of decreasing your cash flow. So it's understanding the difference between those types of reports. percentages that you need to know. We're going to talk mostly about this as we go through the rest of the presentation. Gross profit. Gross profit is left after you've added up all the sales and all the direct costs related to those sales. So your gross profit is the dollar amount. The gross margin, on the other hand, is the ratio of what is left to the overall sales. So you've taken your gross profit number and you compare that to your overall sales number, and that becomes your gross margin. Net profit or income is what's left after of the gross profit after paying all the bills of the business. So rent, salaries, loans, marketing, sales, administration, benefits. And this is not the same as cash, just kind of going back to that cash flow statement versus income statement. And the net margin is the ratio of what's left after paying everything and relating that back to the overall sales number. And I'll show you some spreadsheets here in a little bit to explain what it is that I'm getting at and what you need to understand and look at. Now, these are key numbers that you need to know in operating your business to make sure that you are making profit. There's some jargon that we hear too. So the first one is top line. Top line tends to mean sales. So whatever you bring in, the very first line of an income statement is your revenue. So how much are you bringing in on sales? The bottom line tends to refer to how much net profit you have when everything is all done. Then there are some expenses which are referred to as below the line. They are the expenses of the business that are not related to the cost of producing or running the business. So for example, interest expense tends to be an item that is below the line. Overhead. These are the kinds of expenses of the business, such as rent, benefits, insurance, those kinds of things that can be apportioned to the cost of producing the product. Meaning that when you have people who are producing something, there is a cost to them actually making that item. There is a dollar value per square foot of where they are working or where the warehouse is or where the production floor is. Someone who is directly putting products together, they're going to have benefits related to them being an employee. And so that is an overhead expense. Now, sometimes we'll refer to costs as burdened costs. So it is the direct cost of the product when you add all the overhead to that particular cost. So for example, you could make widget A, and the direct cost of that product would include the material that goes into the product, but also the labor to create it. And then the burden cost is the cost of expenses such as insurance and benefits and the like that relate back to that employee who is actually making the product. Now, to some people that might be listening to this, it might seem a little bit unusual when we talk about this kind of thing, but when you're in the manufacturing environment and also in the distribution environment, understand your overhead and burden costs is really critical to what's going on. If you're in a technology company or a pure service company, then your cost of goods sold is different because it's actually people instead of the manufacturing process. Some other jargon, variable costs. Now, these are the costs that change either regularly or irregularly that are related to the costs of the product. So if you are making widget A, and in January you get your supply and it costs $3 per widget, and then in the next month you see that it's $4 for the cost of those materials, and the next month it's $5 and then back to $4, that is what's called a variable cost. It changes, it can change from time to time as the product is received into the building. Your fixed costs tend to be those that certainly they change infrequently. They change infrequently, like rent or mortgage or insurance. Those tend to change on an annual basis. So yes, they do change, but they're fixed for a given period of time. So while utilities can fluctuate, they're generally considered a fixed cost, as they tend to have nothing to do with whether you make 100 units or 1,000 units. If, on the other hand, you actually work at a place that uses a blast furnace and needs all that gas to create the fire to make everything run, now the utility cost is part of the cost of goods. The variable costs tend to be related to product costs, and some variable costs can be related to marketing and sales. So, for example, if you have commissions based on X number that are sold, that can be a variable cost. And fixed costs tend to be just for the business environment. Again, going back to rent, mortgage, insurance, things like that. So why did I go through all of this? The importance of these basics is to properly price your product to make money, income, profit, whatever you want to call it. You need to understand all of the inputs, the costs of the product and costs of running the business. Those are two separate items, and each are equally important to understanding and making sure that you do receive profit. Another important understanding of these reports is that they're just a snapshot at the time they were taken. So when you take the December 31st annual report of your income and expense report, that is for December. Yes, it's showing everything that probably happened the entire year, but you can do a monthly income and expense report. And you want to be able to understand that there are trends. You want to look for changes over time by comparing the different reports. When you take too big of a view, whether it's semi-annual or annual, sometimes you don't understand what is actually happening there. There might be a lot of fluctuation. There might be a trend moving in a good way or in a bad way, and you want to be able to understand that. You're going to be smart about the ratios because they're a key to understanding the business. So regardless of the dollars, the ratios can be a way for you to quickly understand what's going on with the business. So getting into prices. So I've been doing this for a long time, and I've been working on price changes, price notices, price lists. I've done a lot of this over my 30 years. So I've put together kind of my guideline for pricing changes, what you need to do to watch after your prices to ensure that you are making profit when it comes to the end. And the first thing is you need to review your costs at least annually. In today's environment, with a lot of individual products or components that could be shifting month to month or quarter to quarter, you should really look at them probably every 6 months. And if your company has a lot of really high dependencies on products that come from other countries or are based on precious metals or things like that that can change rapidly, then you might want to look at it being less than 6 months. Now, just because you're looking at it doesn't mean you have to change the prices, but you need to be aware of what they are so that you can make an effective decision later on. You also need to review the costs of your business annually and know when they usually change and by how much. So, for example, one of the things that's been reported, excuse me, is that business insurance has increased at a double-digit rate for the past 17 consecutive quarters. So when you have in business insurance that is continually increasing, you may forget about the fact that that is affecting your bottom line because it's a cost of doing business. So you need to review those costs, and you need to review them on a regular basis. Kind of a sideline is when you look at all of your business insurances, liability, property, and so on, you should probably take a look at and get competitive pricing every 3 to 5 years, just to ensure that you're getting the coverage that you need and everything that's related to your business, because businesses change. And so sometimes you'll need to make adjustments for that. And when is your rent going to increase, and by how much? So if you are renting your facility, sometimes you can be locked into a multi-year rate value. And then when you get to the third or fourth year, there's a big kick. So you need to understand when that's going to happen and by how much. In addition, you need to think about, are you planning on expanding your business or contracting your business? Because that will also fit into what's going on with your pricing. You need to review the gross profit and your gross margin for every single product that you sell. And I'll get to a spreadsheet here in a minute to talk about that. You need to understand your overall gross and net profit and your gross and net margin. And this particular rule of thumb is based on when you're at a manufacturing company. Prices should be about 3.5 times the cost to cover your operating expenses and make a profit when it's all done. Obviously, you need to look at competition, the overall market, to make a reasoned and solid judgment on where you want your prices to go. But that rule of thumb tends to work pretty well when you look at the overall cost of the product and where you want to price it. So I'm going to switch over to a spreadsheet here for just a moment and talk about the fact that, so here we have Joe's Widgets, and here is the expense and income report for the first 2 years. You can see line 6 is the product sales, and I'm just using some fictitious number and rounding them off into hundreds of thousands of dollars. The cost of goods sold, your gross profit. I have next to them the percentages that relate to that as well. And you have expenses, rent, utilities, insurance, salaries, sales, marketing, administration, your total amount of expenses, and your net profit. So you'll notice that in year 1, Joe did pretty well. He was able to get some decent prices on making his widgets. And so his cost of goods is only $20,000, and he made $80,000 gross profit, basically 80% gross profit. For his rent, he's got a good deal on his rent, and he is going to be paying only $10,000 a year. His utilities are $3,000, insurance is $2,000, salaries is $25,000, and hopefully he's paying himself. That's one of the main things you want to make sure of in salaries. Other sales and marketing expenses, administration. This might be where you have some of your bills related to the overall functioning of the business. And you'll see that we've got total expenses of $65,000 and a net profit of $15,000, which when we compare that as a percentage, we have 15% net profit compared to the product sales. So easy enough. We've got 15,000 divided by 100,000. That's 15%. And you'll see that the gross profit margin is 80%. Now we go to year 2, and he's had a 20% increase in sales, which looks great. But now his product costs have gone up a little bit. And so now he's at 21% cost of goods sold, and his gross profit has dipped just a little bit to 79%. He still has $10,000 in rent. His insurance has gone up a little bit, and utilities have gone up a little bit, salaries a little bit, marketing and sales, and so on. And so at the end, he's actually making $25,000, and he's now at a 21% net profit, which is great. He's done a good job in bringing that the keeping expenses low and increasing sales. Now let's look on to years 3 and 4. Again, just $20,000 increase each year for 3 and 4. But in year 3, well, now he's getting hit with some increases on the cost of his goods. And so now his cost of goods has skyrocketed to 29%, which leaves only 71% gross profit. Now, he had a pretty sweetheart deal in years 1 and 2 for his rent. Now he's up to $20,000 for rent. Maybe he's even had to expand a little bit and get a little more space. And because of that, his utilities have gone up, insurance is up, salary, he's got some more people going on, marketing and sales is up a little bit. His administration costs have gone up some. So you can see that his total operating expenses are at $100,000. So he made zero. He made absolutely no profit during the year. Now, year 4, he's still doing well in his sales, but again, now his cost of goods have gone up. And I think a lot of people could relate to that, given the way things have been for the last several months. So now he's at his gross margin has dropped to 66%. But because he's brought in an extra $20,000, he's got $105,000 in gross profit. His rent is still staying the same. Utilities the same. Insurance is up a little bit. Salary's up just a little bit. And when we get down to the end, he's made $1,000 gross profit. So now we get to year 5 and 6, and we can see that he's still increasing in sales. That's great. And he's done a little bit better on his cost of goods sold. So now he's down to 31%. He's increased his gross profit to 69%. Some of this could be based on how he's pricing the products, because the cost of goods is stable, which is great. Rent again is flat. Utilities have gone up some. Insurance always goes up. Salaries almost always go up, and going down the line. But because he's done well, he's at $13,000 profit, only at 7%, but it's better than the year before. And we look at year 6, it's gone up to $200,000 in sales after 5 years, which is good. It's nice. It's not fantastic, but it's very nice. But his cost of goods sold have gone up again. His cost of goods sold as an actual number has gone up, but the percentage has gone down. So now he's back up to a gross profit of 72%. But it's at the expense of, well, now he's got a new facility, and he's got to pay a bigger rent charge. He's got utilities expenses that have gone up, insurance, all of these have gone up. And now this year, he's actually lost $9,000. He's lost 5% on the business. So then we get to year 7, the last year of our comparison. He's gone up another $25,000 in sales, which is great. He's bringing the cost of goods sold in line, and now he's at 73%. And again, the rent is stable, the utilities is stable, insurance is up a little bit, salaries. So at the end of 7 years, he's made $3,000 in that particular year, only a 1% sale, 1% gross profit. Sorry, 1% net profit, 73% gross profit, but 1% net profit. So you can see, I hope, that when you look at the product sales, your costs, gross profit, and all of the various expenses of running the business, that it's important to understand and capture the operating expenses of the business and make sure that you're covering all of those costs. So now when we look at some of the prices for Joe's widgets, we have 9 individual products here, widget 1 through 9, and they all have different list prices and they have different costs. And I've tried to identify some of the gross profits and the gross margins. So some of you might look at this and say, well, he's got a gross margin of 80% on one product and 20% on another. Why would anyone do that? And certainly we've all heard of the phrase loss leader. So there are some times when you want to sell a product at a loss to bring in other customers or bring in more sales from that particular customer. So this might be one of those products. You might also have just not looked at the cost of what it is to make that particular product recently, and now he's only at a 20% gross margin. I can tell you that there's times when we didn't see the actual cost from the producer and wound up looking at some of our products that we thought were profitable and realized that they are actually dragging us down. So when we take a look at this next set, so here we're looking at the costs are all the same, but we've reflected price changes. So now we can see that the first line item is 87% versus 80%, 71%. Widget 3, he's figured out what's going on there with the costs of the goods, and he has made changes to the price. So now he's back up to 60%. Now in the first scenario, we've only got 47% average gross margin. Now, if you go back to these spreadsheets, if the gross profit is at 7, if all your expenses down here at 72%, you've got to have gross profit margin on your products to equal greater than 72%. So he's done a good job on changing those prices, and you see now that he's got a 68% average gross margin. Now, in this last comparison, we can see that he's done a little bit more price adjustments, but he's also done some things with costs. So we now have an average gross margin of 73%. This means that your gross margin of 73% is going to cover all of your business expenses that would equal that 73%. It would mean you have no profit, but that's how you calculate what the average gross margin and gross profit is in order to make sure that you are making money. So getting back to our presentation, we want to compare the gross margin of each product to the gross margin of the company. Is it higher or lower? If higher, good. If low, it's dragging your business down. You're not covering the expenses of the business unless the product is a loss leader. And while you might have one product that is a loss leader, you need to make sure that you've got other products that are carrying a much higher gross margin to offset that loss leader. You also want to look at where each of these particular products is going. Are the sales going up or down? Are they flat? Are they constantly going down? You need to review each of your products for elimination. No product is going to last forever. Obviously, buggy whips went out when cars were developed. So there's a time and place for different products. And if your product has been taken over by an updated product from a competitor or something like that, then kill it. Spend time working on products that are going to make you money. And there is a particular way of actually killing a product so that your customers can empathize with what's going on with your business. You need to give them time to make switches. And maybe your switch is a new product that you're making. Hopefully that's the best possible thing you could do. But if you decide to kill a product, give your customers notice as long as possible. So if you can give them a year, but also give them a reason why they should come back to you for that replacement product, that's even better. But you got to give your customers time to let them make a change. And I've seen it. Don't be tempted to keep the product if after you make that announcement, your sales go up. Too many times people say, oh, well, now sales are up on that product, then we should keep it. No. That is a momentary bounce for people to stockpile or do something with that product in anticipation of the fact that you are killing it. So don't be enticed to keep that product. Once you've made the decision to eliminate it, get rid of it. You should have a regular price increase at least every year, even if it's just a little bit. Prices rarely go down. People know that. People understand that. So if you have your price increases in January, continue to have your price increases in January. And given all the various fluctuations that take place, then you can decide to move it up or push it out, whatever, but try and keep it on a regular basis. Customers appreciate consistency and understanding what's going on. Certainly on all of your prices, price sheets and contracts, price is subject to change. Don't put any further explanation in there. Just tell them prices are subject to change. Because if a customer says, hey, I got your price sheet from 4 years ago, and it says it's supposed to be $1,000, and now you're telling me it's $2,000, I want to spend $1,000. Well, too bad. Prices are subject to change. I can't sell it to you for $1,000 because that's what the price was 4 years ago. And if your business has recurring business and you change your prices regularly around the same time of the year, the customers will have some anticipation and less resistance. So if you have something where they buy it quarterly or semi-annually, and you have those price increases every year and they know it, they will continue to, they will give you less hassle in raising your prices, as long as they're in line and they're not crazy. If you have non-recurring business, for example, somebody buys your product, you have a long product life cycle, once every 3 to 7 years, they already expect that changes to your prices will be occurring. So just make sure that you're keeping up with price changes, and again, price is subject to change. Now, here's where we get into some situations where if you want to keep your customer, and you change your prices, give them a notice. Tell them when it's changing, what's changing. And it's, even if you have a customer that's non-recurring, they buy once every 7 years, give them a notice of the price changes. They would appreciate it more that you're being upfront. You want to be completely honest as to why you're raising your prices, but don't gush. Keep it short and simple. You know, if your prices are dependent on oil, for example, then say that. But don't go into long-winded supply chain issues with, the boat's stuck in the ocean and can't land. Don't do that. Just give short, simple answers. Obviously, they have to make sense, and you can back them up, but don't gush. Just give them the reason and be on with it. Be done with it. If some of your products change more than your overall percentage, so for example, you might say, well, we're having a 3% price change on all of our products, but these two products are changing at 10%. Point it out. Don't hide it. be honest and explain why that particular product has gone up a particular way. Maybe that has a precious metal in it that finally is the price has gone through the roof. You need to make adjustments for that. So don't hide it. Be upfront and explain why certain prices have changed more than your average. And give them a time frame for when the new prices will take effect. You don't want to do it next week. That's really not great. But if you have to, then make sure you got it in there. But it's better to do 30 days or 60 days. Maybe you want to say first of next month or something like that, but give them a reasonable time frame that the new prices will take effect. So one, you want to notify your customers that prices are changing. Two, you want to tell them by how much they're changing. Three, you want to give them a short and simple reason why they're changing. Four, give them a time frame for when that actually takes effect. Chances are when you give that time frame, like a 30-day time frame or first of the next month, you'll get a bump just prior to the price increase because people do want to save a little bit of money when they can. And if you want to, you can give customers a concession on the price for a week or two, but don't go past that. If someone, unless you've made a quote that said prices are good for 30 days, don't go past that. So you want to be careful about when you say prices are valid for and how that moves forward. And if it's a good customer, you want to keep them. And they said, oh, I couldn't get my order in last week because of this, that, and the other, and you want to be nice to them, then give them the old price. But don't make a habit of it, and don't do it for much longer. You can't keep going back to that same well. So in summary of everything we talked about here, we need to understand your accounting basics. You need to understand how all your numbers add up. You need to understand the difference between gross and net and between profit and margin. Cash flow is different than income. Cash is always king. You want to know how much cash you have on hand, but it's very different than income. Also, remember that reports are only at a specific point in time, and that you want to look at those reports over time, and you want to see trends. You want to see where things are going. I always like to use a 5-year window to see where things are going. Quarterly sometimes doesn't tell you enough as to those changes. But if you looked at quarterly sales over a 5-year period, then to me, you're golden. You've got a great idea of what's going on with what's happening. And make sure that you have enough gross profit to cover your overall expenses, both in dollars and percentages. So I appreciate your time today. Thank you for attending. And certainly right now we'll take your questions, and hopefully we can provide you with some solutions. My name is Frank Spivak. I'd like to be your partner in success, and I cover strategy, marketing, brand. I do it through coaching, training, and consulting. And thank you for your time.